Okay, well, welcome, ladies and gentlemen, to our roundtable, the Money Management Roundtable, with Bendigo and Adelaide Bank as our sponsor. One of the points actually that was mentioned by George in passing was the manner in which Bendigo and Adelaide have basically, set up their offering in terms of the lending. And one of the things that I know went very, very wrong as part of putting aside the strategy of Storm, one of the things that went very, very wrong, it transpired, was the back end or the back office of the loans that were actually being provided. There seemed to be a failure to be able to execute exit strategies simply because the back end was failing. Now, I guess there's an awful lot of learnings out of that, and things have, from what George is saying, been put in place in the sort of offering that Bendigo and Adelaide have got that are intended to preclude that.
Well, and it comes back to the basics, I think, and I think one of the things for leveraged equities is that I guess post-GFC and the learnings from Storm and I guess the extra regulations that came about was that in reality nothing much changed for leveraged equities from the processes we already had in place. And what we're talking about here is, communication. It's, working back to whatever time you needed to make sure you let your clients and your partners know. And in our case, we do the vast majority of our business through professionals such as stockbrokers and financial planners. So working with our partners so that their clients knew it was coming. Things like, not changing LVRs on stocks, midstream and those sort of things. So when the regs came in, there was actually very little that we had to, build or put in place as something new. And of course, the change for the industry was, of course, the responsible lending, which regulations, which to your point, Wayne, it's really just looking at how any form of lending and having a responsibility as who's borrowing money and all that sort of piece. But in terms of our processes, we really didn't change much, which we're proud of.
George?
Yeah, look, we've always focused on the advice proposition and ensuring that the education of our advisors, the quality and the appropriateness of their advice is consistent, across clients' risk profiles, their objectives, their goals, and so forth. And we really delegate the expertise of providing strong and robust product to providers such as leverage equities in the space of margin lending. What we do is focus heavily on the education of advisors, and I think that's a central theme here, and really ensure that they're circumspect where appropriate and where clients are aware of the risks, but also the tangible benefits that the appropriate product is put forward.
Michael?
There's a great difference between theory and practice and what really happens. You could have investors around this table and they'll agree with everything that's said. But, suddenly there's a big downturn next week and things change. So it really is, the relationship is so very, very important. And, there would be no anxiety or stress as long as that communication is there and the client, or it's the right kind of client that fits margin lending, because it's not fitted. It's not for everyone. It's not for everyone. So, I guess the problem was from 2003 to 2007, the markets just went up. And so it would be easy to let that regular monitoring of portfolios, the GFC, all it did, it brought us back to what we should have been doing. That's really all it did. And I think those people that are have gearing strategies today, and they fully understand and aware of what's happening. That I guess that's really what's come out of the GFC for me.
Okay, and with that, we've gone our 40 minutes, ladies and gentlemen, so thank you very much. We'll wrap it up there. I think that was very informative, and I'm glad we actually got Storm off our system.